Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job, not just entertain, put it in context. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. Memo to the bears. Beware of an oversold market. It might be a sign that you've overstayed your welcome. Last night I told you that whenever we have an intraday rebound from a big decline based on pretty much nothing, as what happened yesterday around 1:40 to 1:43 p.m., then you could have a chance for a real run the next day. Now, I've staked my career on being able to spot bottoms and tops, and that intraday pivot often signals a real sea change in the market. Sure enough, after a slow start, the Dow rallied 116 points, S&P gained 0.59%, and the Nasdaq jumped 0.83%. Yesterday, again, at 1:40, we had that kind of dramatic pivot that I've been looking for, when the market was once again cascading down, out and out capitulation, and then it just stopped. And then it started rebounding like crazy, almost into the close, because none of the prevailing negatives actually changed. Think higher interest rates and soaring price of oil. The rebound was widely dismissed. Hard to take a rally seriously when the fundamentals haven't changed at all, isn't it? But I choose not to dismiss it, because these kinds of against the prevailing grain moves can be very meaningful. They have been many times in my past. A pivot like this is often a precursor to a change in the animal spirits of the market. You just don't know it yet. This morning, we woke up to rates going still higher while oil briefly touched $95 a barrel. A price so close to our $100 target, 95 to 105 bucks, that I hope you took the opportunity to ring the register. Given how closely the price of oil and bond markets are correlated, any profit-taking in crude could halt the relentless decline in bond prices that's been causing interest rates to soar for weeks, right as we near the end of the awful month of September. And the profit-taking in oil appeared right on time, right in schedule, to bring a smile to bullish traders who are so happy to be within a couple of handfuls of hours before October begins. Normally, that calendar shift shouldn't mean that much, right? It's almost like hocus pocus, but I repeatedly told you that September would be terrible. We said it again and again on the show. That's been the seasonal pattern for many years, and we were banking on it happening again, although we misjudged just how bad it would be for the bulls. Fortunately, if the seasonal pattern holds up, then a nasty September could pave the way for a bountiful October. Historically, the worse things are in September, the better they get in October. And, of course, there was that S&P oscillator reading that I mentioned yesterday. That's the paid service that can show you when too many investors are pessimistic, as measured by selling pressure. The oscillator starts in no man's land, where it tells you next to nothing. But when it rallies to +5, that means there's too much exuberance, and you gotta sell because the market's overbought. Mirror image holds on the downside. When we were -5 coming into the session, all it did was get worse intraday. That's Tinder for anything that's positive, because a -5 reading on the oscillator means we're due for an oversold bounce. And believe me, it's going to happen again if that's the case when I just looked at the numbers. Sure enough, as I mentioned, oil reversed and reversed hard, with West Texas crude falling 2% from yesterday's close and a few more percent from the aftermarket price I was looking at. Could be the beginning of something new. Maybe supply's coming on. This stock market's always pretty binary, though, right? There were a whole series of economic numbers this morning that were all over the map. Some showed economic strength, others showed economic weakness. But lately, all that mattered is the price of oil. Now, some of that's relative. The price at the pump mattered to the consumer psychology, of course. When it goes lower, we feel better. But some of that's simplistic, meaning money managers who will sell bonds no matter what when they see oil going higher, because oil is a leading indicator of future inflation. Either way, when oil reversed, the bears were caught leaning in the wrong direction. They lost control of the narrative for once, and the whole market suddenly improved. I want to give you some examples of the sea change and how it works. For instance, we all know that tech's been pretty miserable of late. Last night, Micron, a gigantic semiconductor company, reported a good quarter paired with a miserable forecast. Now, the analysts have been looking for the exact opposite. They thought there was going to be a bad quarter with a good forecast. The grim guidance normally would have crushed the whole tech sector. I thought it might. However, when I interviewed Micron's CEO, Sanjay Mehrotra, this morning, I found the situation confusing. Because while he saw his chip business bottoming, he didn't see that being followed by a big increase in earnings, which is normally what you'd expect, right? In fact, it was the opposite. He expects free cash flow to stay incredibly negative I know I was very let down by the projected losses. I thought Micron's forecast could put a damper on the entire group when I saw how bad it was. Instead, and this is the sign of the sea change I'm talking about, Micron's bad guidance was ignored by the rest of its sector. The semis rallied anyway in a remarkably positive display that brought up everything from Applied Materials, NVIDIA, AMD. It was among the best performing sectors in the entire market. Next example, the auto strike. It's got a lot of people on edge. But for the first time, we saw some flexibility from the UAW. There was a report today that the unions now backed off the 40% wage boost demand, and now they're asking for 30%. That, to me, is a sign that while they want higher pay, they no longer want to wreck their employers in the process, which seemed to be the case just days ago. A sector that's become untouchable finally had something positive come out of it. Later in the show, I'll make a case for maybe be a little cautious of consumer spending, but today the retailers put a pretty good show in a rare break from the relentless slide down, no doubt related to the decline in oil. Now, I think that's ridiculous. Oil going down a couple of bucks won't translate into earnings bump for Macy's or TJX or Costco for that matter. Still, that's how this market works. It's silly sometimes, but that's the correlation. Retailers rallied. Of course, this is an easily dismissible run. It's been denigrated repeatedly as nothing more than a short covering effort all day on our air as the bears ring the register and take some profits. And when you're a short seller, you ring the register by buying stock. I want you to take the opposite approach, though. Sure, when you get a big decline followed by any rally of any significance, it is natural to assume that the whole move is fueled by short covering. As you can imagine, when you see stocks climbing on the thin read of a $2 decline in oil, it seems like there's nothing else to it. But what if I told you that what happened today is really very different from what's been going on? That approximate 1:40 p.m. bottom yesterday, the intraday bottom, the huge sellers of text, they finally finished selling. Maybe it was because they feared October, which historically tends to be pretty bountiful for tech stocks. Maybe they couldn't rationalize selling so low after causing the low themselves. Or maybe they were finally seeing buyers as they smashed stocks down. It really doesn't matter, though. In the end, the stock market is about supply and demand. At that moment in the early afternoon yesterday, the sellers ran out of supply at a dump. And the buyers, they got very voracious. Buy. Now, what if this rebound's chimerical? As I told my partners this morning on Squawk on the Street, look, you either believe it or you don't. To me, this is how pretty good rallies start. Almost every rally I've ever followed that I liked started just like this, a pivot up and then a break in one of the most bearish of indicators, the price of something, this time crude. Then a sluggish open that tests the decline, the floor holds, and then you're off the races, putting fear into the hearts of the bears. And that is what happened today. Bottom line, no matter what, there's a fascination of finally being through one of the worst months of the year as we head into a new month that tends to perform pretty darn well when it comes in with a full head of bearish steam. That's right. The bears are fueling this one. So we bought a bunch of stocks this morning for the Charitable Trust. If you remember the club, you would know it and be proud. Just like the thesis I laid out here, all I can say is, so far, so good. I like the odds going into a month that, despite a couple of crashes, has been very, very good for the bulls. Alan in Florida. Alan.
Hi, thanks for taking my call. I'm a first-time caller.
Excellent, Alan. How can I help?
You know, Jim, I've been trading for over 50 years, I hate to admit. And I've seen companies buy back stock responsibly. I've seen other companies destroy themselves by buying back stock. Mm-hmm. But BKNG is something I don't understand. They have unbelievable earnings. They have bought back stock with all of their earnings. But in addition, they have gone into debt. In the last year, they've gone from $8.5 billion to $13.7 billion. In the next quarter, probably over $15 billion in debt buying back stock. And their shareholders' equity in the last 2 years has plummeted from $8 billion to a negative number. Am I missing something, or is this a recipe for disaster?
Well, I don't think it's disaster because I think the company's business is very good, and Glenn Fogel is a seasoned operator I've known for a long time. I don't like what you just described, though. That makes no sense whatsoever. You just don't do that. And we're going to have Glenn on. I'm going to ask Glenn to come on and explain that because you deserve that. After 50 years, you deserve that. And I thank you for your confidence in calling on me since you're completely a pro raising a very good question. How about we go to Zach in Texas? Zach.
Mr. Jimmy, how's it going, man?
Not bad, you know, kind of hanging in there. What's going on with you?
Oh, man, hey, I'm just getting ready for that Packers game tonight. Go, Pack, go.
I don't know. Is Watson going to play? I mean, is AJ back?
Watson's playing. Watson's playing.
Watson's playing? Then you're going to win. You're going to win. That's it.
Oh,
I know you're going to win.
My man, Mr. Jimmy, Mr. New York City. All right, man, here, I got a big dilemma going on.
Okay.
So I invested and a lot of shares last year in Disney stock. I want to say around the 140 price range. What do I do from here?
All right, I had this discussion with Jeff Marks today for the club, and I said, you know what? I think the rally is going to start in October. Maybe we buy some Disney. And he said, maybe not. And I didn't say anything. All right, it remains to be seen whether or not yesterday's reversal has staying power, but the thought of coming into one of the best months of the year full of bearish sentiment, that ain't cutting it here. Man, buddy, tonight, Workday's holding its annual user conference. Workday rising in San Francisco, and after a host of announcements, the stock still plummeted today. At its worst day since March 2020. What a bummer. Is today more? Was that warranted? I mean, come on, or was it an overreaction? Why don't we speak to the co-CEOs? Then fintech faltered the last couple of years and is still not back in style on Wall Street. So what is in the segment? I've got it. And Train Technology, yeah, TT, it's looking to be the king of climate. So is that the thesis investors should focus on going forward? I'm getting an update from the company's top brass. How about those questioners? Weren't they terrific? Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.